Bloomberg is now on your dashboard. With Apple CarPlay and Android Auto, it gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. It's free with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple App Store or on Google Play. Just download the app, connect your phone to your car, and get started. And it's all presented by our sponsor, Interactive Brokers.
Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast.
When you want to talk rates and Fed and all those banker stuff, you turn to Ira Jersey. You know, you head down the Turnpike, the Parkway, Route 1, you get to Princeton, New Jersey, and that's where Ira Jersey is with the Bloomberg Intelligence strategy team.
By the way, on your way there, you can stop for gas and fill up for what, $3.13?
Yes, on Route 71 in Wall Township this weekend.
Which
all-time
is,
low,
just a drop for the energy prices. And that's part of the reason, Ira, that we saw this inflation report come in light. It's good news, obviously, for the Fed. If you buy it, it's good news for the country as well. Does this mean no more hikes are necessary?
Yeah, I think this number takes hikes off the table, I think, at this point. And like you mentioned, the WIRP function and just looking at what short-term interest rate products are doing, we're now pricing in for even more cuts in 2024. I'm still skeptical that the Federal Reserve will actually cut, but certainly the market is thinking that there's a risk of that. And this is what's been happening, though, is that the market's been extrapolating these trends from single numbers. And we have to think that, okay, maybe we got a zero inflation this month, but next month if we get a 0.1 or a 0.2, it's still slower inflation than we had earlier this year, but it's still not going to be necessarily near the Fed's comfort zone, at least not yet.
So what other parts of the market do you look at to get a sense of kind of where future rates may go here?
Yeah, so the big market now, it used to be the euro-dollar market, and not meaning the actual dollar, but meaning dollars in Europe and interest rates on short-term products. So if you look at the SOFR futures now, you've seen a big shift over the last 2 weeks, where SOFR was thinking at the end of 2025 was going to be that we were going to have short-term interest rates somewhere around 3.5%. Now it's even lower than that, right? So we're seeing some shifts in the market that like 25 basis points over the last 2 weeks in the market's expectation for where rates are going to be in 2 years. So SOFR futures are a big one. Obviously Fed funds futures as well, but Fed funds futures, most of the volume is really in the first 6 months of those contracts. So you looking at longer term and what the market's thinking for policy rates, SOFR is the much better product for that.
By the way, Paul, you have made a killing on your 2 years.
Sure.
As the rate obviously comes down, the price goes up. You don't need to worry about reinvestment risk. You can sell those things at a profit.
Exactly right. I mean, just today, we had 5.04. Now we're 4.85%. So just a big move in the short term.
Yeah, these big moves keep happening. Is there any problem with this much volatility in the Treasury market, Ira? I'm looking at 20 basis point drops on 3s, 5s, and 7s, and almost that much, 18 and change on 2s and 10s. Is that a problem?
I don't think it's a problem. I think it's a sign of the new environment that we're in, with the amount of bonds that are outstanding versus the capacity of dealers and other intermediaries to actually see all the flow and take on risk to redistribute that risk at some point is much lower today. And part of this is electronification of the markets and the like. So you're likely to continue to see these. So actually, we were just looking this morning at comparing where the types of moves we're seeing now versus, say, 1997, when you had interest rates that were a little bit higher than they are now, but 6-7% on the 10-year instead of 4.5, 5. But you actually had regularly 15, 20 basis point moves. So, given the level of rates, this is not that unusual. I think the thing is we were used to the last decade when interest rates were near zero, and when you had 10-year yields at 2%, a 5 basis point move seemed really big. Now that you're at 5%, then maybe a 10 basis point move or a 15 basis point move is kind of on the larger size, but also not particularly unusual. So I think you'll see more of these, partially due to rate, partially due to shifts in the market structure that are just going to provide for more jumps in the market when people are one way and want to get out of risk or into risk in because of data or because of some news out of the Fed, for example.
So, Ira, when I first got the Salomon Brothers, Salomon had like an army of government bond traders. No kidding. I mean, just dozens of them. And they were all trading for their book, trading for clients. And they made a lot of money. I'm guessing they also lost money from time to time. Does that even exist on Wall Street anymore? Do government trading desks exist, and are they profit centers anymore?
So there are government, there are clearly government bond traders. I think that what you've seen, and this started, in the last 20 odd years, and progressed while I was on the street myself, is that you went from having, 5-6 people trading treasuries and just treasuries to having somewhat less than that, because you have more automated pricing. So you get auto pricers and electronic trading platforms that basically look at supply and demand and price smaller trades in just electronically without necessarily the dealer having to take much risk. But for those bigger trades and for trades that of decent size, you still have a person who has to accept that trade because whether or not it fits their risk limits of their trading book. And banks make money on this. You talk to Allison Williams, who covers a lot of the dealers here at Bloomberg Intelligence, and you look, and sometimes fixed income trading is a big profit center, and then other times, obviously 2022, for example, was not a particularly good year for trading, primarily because you get stuck with risk, and because you get stuck with that risk, you wind up losing money when bond prices go down and yields go up. So I think that the market's changed, and certainly the size of the market and the size of the dealer community has shrunk a little bit, right, in terms of personnel.
And the liquidity?
And also risk taking. Yeah, liquidity is definitely lower. So you look at the Bloomberg Liquidity Index, which basically shows you how much off the run bonds. So these aren't like the current 10-year, but the 10-year issued, say, 6 months ago. Liquidity in those securities in particular has gone way down. And that's really where I think you see some of the pain points, and one reason why dealers aren't willing to take as much risk in some of those off-the-run securities. So getting out of risk sometimes is going to be much more difficult today than it had been in past years.
Yeah, I don't know. I'm sticking with my thought that we had way more fun on Wall Street than the kids do today.
I'm sure you did.
Sticking with that point.
Well, it depends which kids, right?
I'm just, I walk on a desk today, I'm like, there's nobody there. I mean, there's a relatively I don't know. But anyway, they're making tons of money over there, so good for them. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Mikey Shah, he is one of our senior analysts over in London, covering the pharma space. He's been doing it a long time, along with that guy Sam Fazeli. Mikey's got much better hair than Sam Fazeli. We'll go there right away.
I'm jealous.
Exactly.
It's overflowing.
So, Mike, you guys have done a ton of work on these GLP-1 drugs. Can you frame out, we've had a little bit of time now to kind of think about this and look at the different products out there, but where are we in terms of developing that market, that part of the market?
I mean, in terms of penetration rates of GLP-1 drugs for obesity, I think we're still in the very early stages. Excitement around the class is constantly growing, even more so after this weekend where we saw the detailed cardiovascular outcomes data in obese patients for Wegovy. I think that was met very positively by the prescriber community in general. We saw kind of early benefits as early as day one in terms of, these drugs can reduce major adverse cardiovascular events in these heavy obese patients. But there's also still a lot to be kind of learnt in terms of the mechanism itself. When we look at the two curves of interest are the cardiovascular outcomes curve and then the body weight curve. So we saw
and diabetes, right? Because if you're pre-diabetic and you can't stop eating Haagen-Dazs, this thing could be a lifesaver.
Yeah. So when we look at obesity, it's a risk factor for diabetes, and in that data set, it showed that it definitely cut the move of pre-diabetics to developing diabetes. The key question though with the data is, yes, body weight is a contributing factor. But given the disparities we saw in terms of maximum weight loss being achieved, and that early separation of the cardiovascular outcomes curve, it's not the sole, driver. So
right. There's a secret ingredient. What's doing it?
Yeah, that's what Novo said. It's got an X factor, which we need to find out more about.
Well, that's what you did. Like this weekend, you were at a conference, right?
Yeah.
Up in Boston. Where was it?
It was in Philadelphia.
Okay.
Oh, so you saw the apparently multiple rounds of applause when the data were released.
Yeah. So the room was full. It was like almost a standing ovation.
Okay. No, okay. When I go to a conference, this is my schedule. I get up, have a little business breakfast, maybe a little business lunch, maybe a meeting in the afternoon, and then boom, dinner. Then we go to the craps table in Vegas. That's how you do an investor conference. These guys, healthcare, they go on the weekend. And they go into these conference rooms for like 10 hours and have to deal with all this medical scientific data. And you guys actually have to write research notes based upon this stuff on a weekend, by the way. That's what you guys do, right?
Yeah, that's about right.
See, that's just no way to do it.
Yeah, but your badge is worth 2 drinks at the meet and greet after.
Yes, exactly. All right, but in reality, how have you guys sized out this market? Because
listen, I have some important questions.
Okay,
because I want to get this. I've got a doctor's appointment on December 7th, and hopefully he's going to hook me up. I need to lose 20 pounds. I want to avoid getting diabetes, and I don't want to die of a heart attack.
Well, then this should be better.
And I have I have no willpower, right? So I'm hoping that this drug can do this for me and maybe do my taxes as well. I don't want to lose muscle. I only want to lose fat. Is there a competitor to Ozempic / Wegovy that is going to help me with that?
In terms of the data with regards to kind of lean, the loss of lean muscle, it's limited at the moment. But Lilly has done a deal for a drug, which potentially, when used in combination with their drug, which is just got approved as Zepbound, that could potentially address that issue.
Okay, so that's one question I have. The other one is, do I go Ozempic because I really want to avoid diabetes and a heart attack? I need to lose 20 pounds. I don't have to, right? I'm not morbidly obese. Or do I go Wegovy because it's a stronger dose and actually has better results for heart issues?
In order to get Wegovy, because of the supply issues, it needs to be on label, right? So you need to be either overweight with a weight-related comorbidity, so that might be diabetes, or you need to be, clinically obese, so BMI of 30 or above.
Okay, I don't check that box, but I feel like I know people. I can go to Canada, I can get the drug elsewhere. But so you're saying, is Wegovy the right choice, but it's going to be hard to get, or should I just settle for Ozempic?
At the moment, there's a lot of off-label use of Ozempic simply because of the supply situation with Wegovy. In essence, the active ingredient of these drugs are both semaglutide, and in both cases, you would start off at a lower dose and then start titrating up. So the maximum dose for Ozempic is 2 milligrams.
All right.
The maximum dose for Wegovy is 2.4.
All right. Amy from South Carolina writes in, how long does someone have to stay on the weight loss drugs? Forever? Few weeks? And when you stop taking it, does the weight come back on? What's the data show there?
Yeah, so there's clinical data from both Lilly and Novo showing that, as soon as you stop these drugs, you eventually, put the weight back on. Prescribers we've spoken to as well, they're all kind of saying, chronic dosing of these drugs are needed. But I mean, there are various kind of things that you could, potentially do. You could potentially, reach your targeted weight loss, and then perhaps you lower the dose of the drug.
Who pays for this stuff?
So that's one of the main questions at the moment.
You got to go to the money.
Mikey, we have the same insurance provider. And if I go in there and I test like positive for pre-diabetes, or if I have a BMI of like 27, 28, is my insurance gonna pay for this?
I think as we get more and more data, we're going to see kind of access and reimbursement for these drugs improve. I think the outcomes data for Wegovy, is a big step in the right direction there. What insurers need to do is, balance that the short-term costs, which are going to be high, of GLP-1 therapy versus the long-term benefits in terms of, saving. Cost savings through reducing kind of hospitalizations and cardiovascular deaths.
There's an actuary at Novo Nordisk, and the boss comes into his office and says, how much does heart disease and diabetes and obesity cost the world? And he says
trillions.
Yeah, and then he says, okay, let's price our drug for that price, right? That's exactly what they want to do. They want to get it so some studies say it saves, some studies say it doesn't, but it's basically at the same level.
Yeah, I mean, like if you look at the direct and indirect costs of obesity and diabetes, it runs into the trillions, right? And all the prescribers we spoke to at the conference, they believe in these drugs. They believe that eventually they'll be cost effective in terms of, as we get more competition coming into the market, that price point will come down. As we see orals, which are cheaper to produce, also get approved. That price point is going to come down.
That's what we need. All right, Mikey Shah joins us. He's the senior industry analyst at Bloomberg Intelligence. Dude, you got to come here to New York more often. We see Sam a lot. Who cares? We'd rather talk to the smart money behind the healthcare research at Bloomberg Intelligence. Mikey Shah joining us here in our Bloomberg Interactive Brokers studio.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jake Saper knows. Did I pronounce it right?
You did.
Jake Saper, founder, general partner of Emergence Capital. He's out there in Silicon Valley. He does all that stuff. So when we talk about AI, Jake, I like to ask people, just say, from your perspective, what is AI?
It's machines helping humans do their jobs.
Machines helping humans do their jobs. All right, I'm down with that. So how do you guys view that space, and maybe how you view investment opportunities for your venture capital fund?
Totally. Well, I'll start with just some context on like where we think this fits in enterprise software more broadly. We're focused just on enterprise software, B2B software, something that obviously near and dear to the hearts of Bloomberg folks, presumably.
Absolutely.
Our firm started 20 years ago with a thesis that software would move from on-premise to the cloud. Okay. That thesis largely worked, right? So the very first investment for us in 2004 was in Salesforce. We've been investing in all sorts of enterprise software companies like Zoom ever since. And we think that this AI wave is very similar to the wave of on-prem to the cloud. So just like that was transformational for tech, we think this will be transformational. We're very bullish, and we're very focused on how we can help B2B software companies make that transition.
But should we have a fast food company talking about AI on our quarterly earnings conference call?
I think it's real, right? Like there's so much hysteria, and so you have to cut through all the crap to figure out what's real. But like in the case of fast food, the idea of using this to help augment the people doing the drive-thrus and make drive-thrus more efficient, like that's very real. Voice recognition technology is real. So I think what may be in danger is I think a lot of tech companies, public companies over the past 6 months have gotten so excited they may have overcommitted, overpromised on what they can do with AI in the near term. So we may be, near term negative, but I think over the long run this thing's going to work.
Dude, think about, you don't want a high school, like a stoner that you hired for your drive-thru to be like, do you want fries with that? He's not going to be enthusiastic about it. He's not going to remember to ask every time. Like AI can be better at upselling in the drive-thru. I think
stoners are pretty good at upselling, though. I feel like they're hungry.
True. Man, these fries are so good.
Exactly. All right, so what's the next? I want to say what's the next because I don't even know where the starting point is. But
well, NVIDIA is the only one that we really know, right?
Yeah.
I mean, Microsoft, okay, with OpenAI, but where do you invest? I mean, you're not looking solely at public markets, so you have a much better view of what the roots are down underground. What are you looking at?
So the way I'd think about it is like there's different layers to the AI stuff. There's NVIDIA, which is at the base layer, right? It's the actual chips that are helping power this. Then there's the foundational models. This is OpenAI, and Microsoft's developing their own in addition to OpenAI, and there's a bunch of others. And then there's the application layer. And that's the stuff we're most excited about, which is what do you do with this stuff once it's built, right? You don't just build it for the sake of building it, but how can you make the stoner dude more effective at taking your order? How can you help doctors treat patients more effectively? How can you help lawyers go through contracts more effectively? So we're investing in companies that do all that stuff aided by AI.
So, all right, now given it feels like we're in the top of the first inning for AI.
Yeah.
Where are you guys looking, and what types of deals are you guys looking at?
Yeah, for sure. So we're seeing a lot of activity in vertical specific AI solutions. And this actually mirrors software. So in the first wave of cloud technology, horizontal SaaS was the thing. So Salesforce, Workday, et cetera. In the second wave, it was vertical SaaS, or what we at Emergence call industry cloud. These are companies like Veeva Systems, which is a $30 billion public company selling into the pharmaceutical industry. The same thing is starting to happen in AI, where you're taking this technology and instead of just trying to broadly apply it anywhere, you're actually choosing a specific job to be done, and you're having it solve that problem. So we have invested in companies, as I said, that use this technology to help lawyers draft contracts better. So the idea is you can, as you're writing a contract, say, hey, help me make this clause mutual, and it will use AI to help draft that. We've invested in companies that help doctors communicate with insurance companies and write the letters to get approvals for different treatments. A company called DXCM that does that. So that kind of concept we think is going to be really powerful. The question is, what are the jobs to be done for which this technology is most applicable in the near term?
And what are the data sets that they use to train on? Is that like a sticky issue? Because recently Elon Musk came out with his competitor to OpenAI, Grok. And apparently it's supposed to use real-time
Twitter data.
Yeah. I didn't even know they could do that without breaking certain, privacy clauses. Maybe they don't mind. But, I think of Google, they have so much data, at their fingertips. Can they use all that?
So I think the larger companies are the ones that have to be the most conservative about this, which is kind of interesting, actually. Like in many ways, those are the folks that have the most to lose. And so startups, I think, can be more innovative on this front. They can, find different sets of data and actually kind of outmaneuver some of the incumbents. There's a real innovator's dilemma problem for the incumbents here. Right? If you're Google, if you're Salesforce, if you're one of these established public companies, you have a lot to lose in this from a legal perspective. You also, if you drastically try to change your UX, your user interface, let's say doing a chat-based interface is better than doing the traditional interface, you could piss off a lot of your existing users. So there's risk there. There's also risk on business models. I think a lot of these technologies are starting to think about how do I charge not on a per seat basis or usage basis, but actually on an outcomes basis. Because this technology actually can help you process contracts more quickly or cure patients more quickly or what have you. What if you could start actually charging on that basis, which would be disruptive to the incumbent? So as a startup investor perspective, which is what I'm focused on, I'm spending a lot of time thinking about what are the advantages a startup has over the incumbent in this new era.
How much incremental CapEx, if I just look at the macro tech CapEx numbers I get from IDC or whatever, and I see some of these big growth rates, how much of that do you think is incremental AI or maybe taking from some other bucket and putting it into AI? I don't know how much to think about as how much is incremental.
It's a really good question. I think some of it will actually come from labor. Right? So if you had hired a consulting firm before to help you implement some new technology, and you had a big budget for that consulting firm, it's very possible that you can use AI to help you implement this technology more effectively, and so you don't need to spend as much on consulting firms.
Interesting.
Which actually brings me to another point I've been reflecting on, which is we thought that it was like the stoner dude that was going to be most at risk in this age of AI, that it was a lot of the kind of more blue collar workers, the janitors, the nannies, et cetera. What's happened with this past year of AI is it seems like white collar workers are actually the ones that may have more infringement upon their daily work.
Yeah.
And as a result, they're the ones who have to probably get up to speed faster on how to make use of this technology to augment what they do. Otherwise, they may fall by the wayside.
I always think about this as well, the jobs at risk, but what will be created.
Yeah.
Because every time there's a technological wave or an industrial wave, it does knock out a whole group of jobs, but it also creates so many more.
Totally.
So what's going to be created here? It's
Yeah.
not just more coders, right? Please
No,
say it's not more coders.
No, in some ways we may have different types of coders in the sense that you may not need to know as much code because the AI can help you do it. So you'll have probably more of a democratization, so there'll be more people that code, but you may have less people that do it as their full-time job. I do think like in the near term, figuring out how to implement this technology in existing tech stacks is something that everyone's figuring out real time. Remember, like this ChatGPT thing, it's a year old. Like we've aged a ton in a year. So what's it going to look like in a year or 2 years from now? So I think the world will look different and jobs will look very different.
Hey, Jake, just on the VC business today, talk to us about what it's like out in Sand Hill Road out there, and if I have a cool technology, will you fund it?
Well, I'll start by saying Sand Hill Road isn't what it used to be.
Really?
Yeah. What I mean by that is like...
And where did Sand Hill Road come from?
Sand Hill Road went to San Francisco.
From
Sand Hill. So Sand Hill...
From New Jersey, actually.
Oh, sure.
And
And
fair Menlo Park, California, where'd that come from?
It was
Menlo
copied
Park,
from
New
Jersey. No, much love to the East Coast. Like, there's so much happening here.
Institute for Advanced Study, Albert Einstein.
Okay.
My backyard. Go ahead.
There's a lot of history that came from the East Coast that made West Coast what it is, and actually the military is a lot of what made the West Coast and Silicon Valley what it is. Anyway, Silicon Valley and Sand Hill in particular have moved up to San Francisco largely. I think there's more action there. We're at Pier 5, actually right next to Bloomberg.
Us, right? Yeah.
But you get that Humphrey Slocum action.
Yeah, like there's a lot of ways to. You were talking about Wegovy before, so if you want to, get on that train, that might be the right way to do it.
I need to get some secret breakfast first, and then I'll do the Wegovy.
Exactly. But to answer your question on like what's the state of VC, there's kind of a weird bipolar state of VC right now.
And we got about 20 seconds.
Cool. What I mean by that is like there's lots of hysteria and excitement around AI, some of which is justified, and there's also some real challenges that these companies who are dealing with high interest rates and having slower sales cycles are facing.
All right. Yep. We'll get you back next time you're in the big town here. Jake Saper, he is the general partner of Emergence Capital.
We can do it over Zoom too.
We can do it over Zoom. We love Zoom.
No, I don't. We go real time here. That's how we do it. Jake, thanks so much for joining us here. Markets tearing it up here today on the back of some good inflation data.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I did not know what CGM meant until just recently. Continuous glucose monitoring. That's a big deal.
Well, and I've been interested in it. I don't have diabetes yet.
You're in good shape. What are you talking about?
But I'm sure it's in my future because I eat so many sugary foods. But, well, I mean, fortunately, I'm trying to stop. I've been interested in these continuous glucose monitors for a while just because I'd like to see how my body reacts to different foods. For example, you and I could eat the exact same meal, and we could have very different responses in terms of, how that makes our blood sugars react. And I think it's really interesting information to have, especially interesting for athletes or for people who are really monitoring their health closely. But for now, diabetics are getting to use these products and have insurance pay for it.
Jereme Sylvain joins us. He is the CFO of DexCom. That is a NASDAQ-listed company. DXCM is a ticker to put in there. They are based in San Diego, I believe. Nice choice. Jeez, lame.
Why aren't we all based in San Diego? I don't understand when.
I don't know what we're doing
when
wrong
the founding fathers set everything up.
Exactly.
Why New York?
And why Washington?
I mean,
DC?
it's nice, but
all right, Jereme. Thanks so much for joining us here in our Bloomberg Interactive Broker Studio. DexCom. For our listeners, tell us what you guys do, kind of how you play the game here.
Yeah, sure, and thanks for having us here. DexCom, we make continuous glucose monitors, as you mentioned, our G6 and our G7 series, as well as DexCom 1. And what the product does is that there's a small needle that goes right beneath your skin into your interstitial fluid. It monitors your glucose throughout the course of the day. And so for anybody that is monitoring their glucose levels because they take insulin, because they take other drugs like GLP-1s, as they monitor their food, their sleeping patterns, and ultimately their exercise patterns, we're able to monitor in real time and give feedback as to how your glucose levels are moving in your body, really minute by minute. Every 5 minutes, we send a ping to your phone or to the receiver. We do that. It's obviously very beneficial to those that need to manage their glucose levels. And by the way, that really spans the entire population. It's really the fifth vital sign.
So, but it's interesting that you say you can use it to work with GLP-1s, to work with semaglutides like Ozempic and Wegovy. Are you seeing more customers do that?
We are. In fact, what we see is if you look at the prescribing patterns, you're really realizing these are companion therapies. You're seeing our prescriptions actually increase when you have somebody who's using a GLP-1, and what you find is the outcomes are better. There's an increase in A1C reduction when you have somebody using both of these products. And so, we think about it as, if you want to think about it as therapy and diagnosis coming together, the therapy is the drug, the diagnostic is the real insight into what's happening in your body. Those two things are an incredibly powerful combination. You're seeing physicians prescribing more and more in that pattern.
What are your CGM business? That is your business.
Yes.
Okay. What are the growth drivers on the top line for you?
Yeah, absolutely. I mean, the total addressable market is huge.
Okay.
And it's one of those things when we sought out to meet an unmet need, we realized, and you mentioned sugary foods,
Yep.
A lot of us are sitting down more often than we have in the past. There is a challenge with glucose levels in the body. It started with folks using insulin, but it's really progressed beyond that. And so when you think about the entire population, diabetes, 30 million in the U.S., pre-diabetes, 90 million in the U.S., global diabetes, over 500 million.
Wow. Yep.
And only about 1% of the people that have diabetes in the world are on this therapy. So there's 99% to go. And so there's a real opportunity for us to continue to drive adoption, really change people's lives.
So is your customer the physician?
Our customer is the physician, the payer, and the actual customer themselves. I mean, really, this is incredibly personal to the actual patient. They wear it on their body.
Yep.
The physician clearly wants to know it. It helps them titrate medication. And then obviously the payer wants outcomes. And so you have to have a product that delivers outcomes. Ours delivers outcomes.
So I've seen, you see the YouTube videos or Instagram videos where somebody just kind of slaps it on the bottom of her arm or his arm. It doesn't look like it hurts. You say needle, but I feel like it's more of a wire almost, isn't it?
That's what it is. I mean, I'm wearing one now. Basically, you put on your body, you click a button, it comes on. I don't feel it. Most folks don't. When I say it's a little needle under, it's about the size of a hair, and about a quarter of an inch.
And how long do you leave it in your arm?
For 10 days. So it stays in there for 10 days, giving you feedback over the course of those 10 days. Real easy to put on, real easy to take off. Pairs with your phone, pairs with other devices as well.
And do you leave it on all the time? Do you constantly have one on? Always.
You have it on 24/7. You swim with it. I noticed you mentioned San Diego. You surf with it. If you guys ever want to try it and come out surfing with us, you're more than welcome to. But absolutely part of wearing it 24/7, so it gives you that 24/7 feedback.
What do you notice? I mean, when you have, I don't know, a glass of wine, do you see a change? When you have, peanut butter? I mean, what are the things that you notice?
You change your habits. You really do. I'll tell you what's good: whiskey. That's a good one. What's not good?
I think
beer.
We all agree.
So there you go. I mean, you're going to have to battle between those if you want to keep it. But there are foods that you eat that you realize, to your point, your body interacts with differently. For me, it's rice. Rice sends me through the roof. And so what I've done is I've changed my behavior around my eating habits. I stay away from rice. I don't want that to impact my glucose levels, which obviously impacts your health.
Why are you wearing the patch?
So I wear it for the similar reason. I like to, well, one, I'm a bit of a sensor nerd since I work at the company.
So you're not doing, is this a prescription thing?
It is a prescription thing. I have a prescription.
And why did you get the prescription?
Because I wanted to monitor the glucose levels. It was really important to me for long-term health considerations.
But the target market is what?
It's still those.
Is it you? Or is it just somebody who has an underlying condition that requires this type of monitoring?
Today, it's really targeted at the diabetes population, those impacted, so that population. But longer term, it will, we believe, go well beyond that. To folks that are monitoring their health before your physical.
So the Apple Watch isn't enough. We got to go another step. You're taking it another step.
You have to be accurate. And that's the big thing. The difference between a healthy person and someone with prediabetes is very, very small. So accuracy is paramount.
Yeah, 90 million people have prediabetes.
I go once a year for my checkup. That's not good enough?
You, I'm sure, are a healthy eater and an active fitness guy. You don't need to worry about it. But I'm cramming like peanut butter and jellies down my throat as fast as I can. And I like to watch TV.
How much does this cost for Matt when he doesn't have a prescription?
When you don't have a prescription, you can get online. It's $179 for a month. That's 3 different sensors, 10 days each. And then I just think it's interesting. You know that rice drives your blood sugar higher. I would not have any idea if I'm sitting in front of a bowl of rice that that's going to do it.
So, we take these tests. The doctor will say, hey, avoid sugary foods, don't eat anything after dinner, and then come in the next morning. I will avoid ice cream and, obviously cake and candy, but I probably would eat a bowl of rice, no problem, and even sneak one in after dinner.
Wow, look at you going crazy.
Well, but then I would get a bad result on the test.
You might even find out that the ice cream is actually good for you and the rice isn't.
Don't
take my word for
it.
All right, 21 buy ratings, 3 holds, and 0 sells.
The stock has outperformed Medtronic, Insulet, Tandem Diabetes, and Abbott Labs over the last 5 years. I looked at those because they make, competing products or in the same space in the diabetes
What's the
space.
investment message you give to the street?
We have a product. It's the most accurate, simple, it's easy to use, it's covered. So we have a population in front of us, a TAM in front of us that we think is absolutely unparalleled. On top of that, we've been working very, very hard on profitability. I know that's top of mind for investors. And if you look at our performance, a 2,600 basis point increase over the last 5 years in profitability. So when you combine incredible top-line growth, we grew 26% organically last quarter and the prior quarter, along with that profitability in this unmatched TAM, I think you really have an incredible investment opportunity. And we've been communicating that to the investing public for some time. And you've seen that through our growth over the years. Just really passionate about the company and the opportunity ahead.
Yeah, I'm looking at the projections out there on the street, kind of high teens, low 20s, top line growth, EBITDA margin mid-20s, going to high 20s, and free cash flow positive. If you can't sell that, I think you need another job. So that's why we got all those buys out there. So Jereme Sylvain, thank you so much for joining us. Jereme is the CFO of DexCom. The symbol to put into your Bloomberg professional terminal is DXCM. And he got his undergraduate degree from Arizona State, whose basketball team is coached by the greatest point guard in college history. That's Danny Hurley. Good buddy, man.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.